Joining us this morning, CIO for Nuveen's Global Equity Division, Sarah Malik's with us. She's among those recognized this year in Barron's list of the 100 most influential women in U.S. finance. Sarah, thanks for the time. It's great to see you. Congratulations, by the way.
Thank you.
So we're having this discussion. Obviously, you've probably been listening the last couple of minutes. There was some notice of Friday's action, and even with that robust jobs number, at least Treasuries didn't get a renewed massive wave of selling. Do you think directionally Tepper may be right here?
Well, good economic news is actually becoming bad news for investors, and that's what we saw Friday. Payrolls coming in at almost double expectations. Yields are starting to spike, and that's causing investors to become jittery. What we need is clarity on three key things. The first is whether this backup in rates is orderly or disorderly. Our view is that this is a growth-driven spike in rates, and so therefore it's orderly. We're not seeing the typical things that cause an economy to overheat, like a tight labor market. Secondly is inflation. We think it's more of a fear than reality because the Fed should stay focused on long-term inflation, which should stay moderate, even though we do expect to see a spike in short-term inflation. And then finally, what can we do in terms of yield curve control if we need to do it? I think firstly, the Fed could communicate more about it. Maybe we'll see more of that at the FOMC meeting on March 16th. And then also, the Fed can also use its balance sheet in order to try to influence the shape of the yield curve. So all of those things together, once we get more clarity, it should reduce volatility for the markets. And we do agree generally that higher earnings will drive the markets higher this year.
Yeah. Have you been impressed? I know Goldman had a note over the weekend, largely constructive based on flows, despite all the worries about rising rates. Have you been at least encouraged by the degree to which flows indicate continued interest in equities?
I'd say great. We've been seeing strong flows into equities since November, into active management. Not surprised to see it because in these higher rate, higher inflation environments, equity tends to look more attractive. We do think that continue because this move up is going to be more sustainable. And that's why we've been fans of areas such as cyclicals and small caps and emerging markets this year, because those are where you're going to get the most bang for your buck in terms of leverage to this global synchronized economic recovery.
That being said, Sarah, I wonder, are there opportunities in tech right now, given the big downdraft we've seen very broadly?
Yeah, our long-term view is on cyclicals and financials and the return of the consumer. But given the malaise we've seen in technology, we're starting to see some value there. Investors are going to pay for high-quality technology stocks, but less so for premium valuations. So a little bit more into attractive structural growth companies like Alphabet and Facebook, which have more reasonable valuations. Facebook has over 2.5 billion users, 10+ million advertisers. Both of these companies are part of this structural trend to more and more digital advertising. We think they're both very well positioned going forward. And their valuations don't look as expensive as some of these other technology companies, which are selling off because they're long duration in a higher rate environment.
So I guess just talking about this rotation we've seen and the orderly nature of it, is there anything, I mean, what do you see as the biggest risk to the market right now?
The investors get very concerned when yields start to spike quickly, and that's what we saw recently. So as long as it's more of a normal slope upwards and the yield curve remains kind of in a more managed fashion, we think we'll be able to handle this. We do expect to see a short-term spike in inflation, and that is going to bring volatility to the markets. But as long as this is sort of a broad-based recovery over time, I think investors will be able to handle it. We do have the stimulus coming in, which is another positive for the markets. All of this should lead to earnings growth getting stronger and stronger as 2021 goes on.
Earlier, you mentioned the prospects, or at least what would happen if the labor market truly got tight. I don't know if Goldman is right and whether or not we're going to end the year at 4.1. It's certainly not in the threes, but it's getting close. Would you describe 4.1 as tight, and what would be the implications of that?
I mean, 4.1 is getting obviously tighter than we are today. What we would be watching for, one of the keys is wage inflation. So it's not just a low unemployment rate, it's how much wage inflation are we seeing, and that will start to go through the economy and lead to higher inflation over time. So that is a key indicator that we're keeping an eye on, and we're not seeing a lot of wage inflation right now, which is why we're not concerned that inflation is going to become very hot in the near term.
I do want to get your thoughts on the fact that we have seen the dollar and the dollar index strengthen and pretty notably just in the last couple of weeks, especially when we talk about something like investing in cyclicals. How are you thinking about that?
Yeah, dollar, we expect it to be more of a flattish environment from here. We're not expecting a lot of dollar weakness going forward, but that's why we're positive on emerging markets, where we think those currencies can strengthen as the rest of the world comes back. We particularly like those emerging markets countries that suffered greatly during the coronavirus pandemic. So this is Latin America, where Brazil and Mexico were hit very hard. The vaccine is key to them recovering. Mexico and U.S. relations should improve from here. And actually, we still like China, even though they performed quite well during the pandemic. The valuations of Chinese companies are not incredibly expensive now. You can find technology stocks in China that are cheaper than in the U.S., and also areas where the consumer in China will come back to normal, like Macau gaming. We like those two areas in that region.
Shepard Smith here. Thanks for watching CNBC on YouTube.